Every single market that you can look at gives you some thoughts about possible banker trade narratives. Now, the whole concept of any banker trade is what? What is the whole concept of a banker trade? Type it in the box, guys. What's the main driving principle of a banker trade? Main driving principle of a banker trade, guys. What is it? Well, volume is a big one. Yeah, absolutely, but it's not the main one. Well, it is the main one for me. I mean, it's obviously the main one for me. It's the main one for every institution, but it's not necessarily the main one for you guys. The main one for you guys is very simple. It has to be an arbitrage. It has to be as close to a pure arbitrage as you can make it, right? Yes or no, guys? It has to be as close to a pure arbitrage as you can make it. So, for example, if I look at oil, would you agree with me that those three lines are as close to a pure arbitrage as possible? In other words, if I was a bank and I could sell the blue line and buy the purple line and sell the purple line and buy the blue line and backwards and forwards, could I pretty much guarantee that I'm never going to lose money if I can just simply trade those rotations? Could I pretty much guarantee I'll never lose money? Take a look, I mean, make an honest answer on it. I could pretty much guarantee that as long as I've got a big enough account, if I can sell the blue line and buy the purple line, and vice versa, I will never lose money. Correct? Yes or no? Is that a true, fair statement? We'll just look at a couple of examples and you'll see the answers. If I sold the blue line, for example, through this whole phase here, and I bought the purple line through that whole phase there, could I have made a guaranteed profit? Well, the blue line flips the purple line here, doesn't it? The blue line flips the purple line here, doesn't it? So the purple line's above the blue line. So assuming I've got my volatility and my spreads and my angles right on this one, I've guaranteed that I'm going to make money. As an arbitrage, I'm not guessing that the blue line's going to be falling, and I'm not guessing that the purple line's going to be rising. But in most cases, I know what's likely to be happening, and I know which direction that will drive the oil price in. I'm trying to get ahead of that drive. So in other words, if I'm selling the blue line, in most cases I'm going to be trying to buy bottom edge in an environment, aren't I? I'm going to be trying to buy into a bottom edge, or I'm going to try and sell into a bottom edge of oil. But that's not the point of the banker trade at this stage. The point of the banker trade is we've got to find markets that are arbitrages. In other words, the 2's, 5's predictors. In other words, the DVO1 skews. And we can all agree that these are massive, massive oil predictor trades here. Massive oil predictors. So I know, and I can now predict the direction of the crack spread, yes or no, guys? On a macro scale. It seems to be relatively straightforward to understand that I can now predict the direction of the crack spread, yes? I can predict the direction of the crack spread. In other words, I'm selling the blue line. So I'm starting to eliminate some ideas. I'm starting to find my way into a possible macro commercial trade. I'm starting to find an arbitrage, as I mentioned. So obviously, if I can predict the direction of the crack spread, you can see I was a big buyer of the crack spread in here. I was a massive buyer of the crack spread in here. Massive buyer of the crack spread in here. Yes? That's so obvious, it's unbelievable. There's really only been 2 trades on oil in the last 24, 48 hours, and that's been the crack spread sell up here and the crack spread buy in here. That's the only 2 trades that's really been on a macro scale the only two trades on oil, yes or no? You agree with that? And when you're looking at those ideas, you're starting to recognize some of the thoughts. Now, in the short term, that means that you're going to be looking at this and you're going to be saying, how do I get into this? How do I make money on this as an oil trader? But that's not the important question at this stage. You're only trying to recognize that we're making a fortune on the crack spread. It's an arbitrage. It really is almost a perfect arbitrage. I've never known this to not make money. It's that good an arbitrage for the bank, right? So that's good news. We can use that, we can see it, we can understand it, we can figure this thing out. Now that's a great starting point. We can figure this thing out. So obviously when we come to another market like the gold markets, we need to find arbitrageable opportunities. Now the good thing is we can also find markets that have directionality as well as arbitrageability. So when we look at something like gold against the silver on a skew, we can see that this is an arbitrage. I mean, this is even better than the crack spread. I mean, look at it. It's literally sits on top of each other, doesn't it? I mean, there's no idea about value in this one, but it does have directionality to it. In other words, if I know there's directionality to this, I know that when this line is rising, for example, I should be selling gold. When I know this line's falling, I should be buying lots of gold. So that's a direction attached to that. But the arbitrage is so tight, it's very difficult to see any value to trigger a trade. This is, by the way, this is gold minus silver times 130 and gold minus silver times 100, just for anybody that wonders what it is. Gold minus silver 130, gold minus silver 100. So this gives us a negative correlation to gold prices. So when I look at this directional sell-off here, I could start selling, buying some gold. You can see that when that drops there, if I buy lots of gold, I am already getting a directional bet on gold. I am going to make money. And I made a fortune in that gold trade right there. When I see this starting to sell off here, I simply go into the bottom edges and I start buying some cheap gold in that area. And you can see I made an absolute killing on gold on the way back off the bottom edges. Do you see how easy that was to spot it? You see how easy that was? Now obviously just as a directional line on its own, I could simply just flip this whole line over and see if you can spot that buy trade in gold. Could you spot that buy trade in gold? It's so unbelievably obvious, isn't it? Left-hand side of your charts, bottom edge. Now why the bottom edge? Well, we discussed this with gold before. Why are we looking for the bottom edge on gold? Because we don't really have any real value on the gold-silver skew line. It's too close. It's too close to make a decision. It's too close to get a trade on. And therefore, we don't really have a value idea in terms of timing. But we've got a value ideas in terms of macro direction, right? So as soon as I've got a value idea in terms of macro direction, what am I going to do to make any money off of this? Well, simply buy discounts. So when the price starts getting discounted in here, I've obviously got a nice area to get discounts into. So simply when I get a discount in here, I start buying some gold, right? I start saying, okay, well, get me some gold. And then I get another discount here, and I say, buy me some more gold, thank you very much. And then I get a retest on the discount in here, and I say, buy me some gold, thank you very much. How much money did I make on gold? A fortune. And then I get an intern trade here. And then I get an intern trade here. And then I get a spring trade here. And then I get an intern trade here. And then I get an intern trade here. But do I take this intern trade here, guys? Yes or no? Do I take this intern trade? Top right-hand corner. Top right-hand corner. No, because the value is actually dropping on that now, isn't it? So there's no way I'm going to take the interns trade. Not a chance in a million years I'm going to take the interns trade, right? And obviously what happens is we start seeing a value divergence, so I'm going to start looking at getting some value sell. So I'm going to take that sell trade just there. I'm going to take a pop at some selling here. Now when I get that sell trade in, I've just banked $1,000 per contract on gold, right? Just banked $1,000. It's a pretty good profit. So when the gold price starts dropping, however, the line's coming back up again, so I can't go for the squeeze. I can't go for the tipping price. I simply have to get away from that sell trade because I'm now in serious trouble of just getting busted up here. So I just simply scratch out my trade and say, thank you very much, I made $1,000 in the earlier move. I'm not going to be able to make much more from this. And obviously we get a nice squeeze to the upside and a nice sell off to the downside. There's no value for me to do either of those two trades. There's no value. So I just have to wait. Now you might be saying, but you know, what about this now starting to form some value in here? Yep, it is starting to form some value. I'm starting to look at this as a possible buy trade off of level 2 key liquidities. We can see that the volume dropped off, the volume increased here, so that could be your first opportunity to start buying into this. This also ties in with this level 2 liquidity here. Now remember, you're not using a timing signal because it's too tight to the markets. Now what else could you use? If you're looking for a timing signal, what else could you use? It's gold silver, it's the same, it's just the other lines flipped. That's all it is. So I gave the other lines earlier. It's just those lines flipped. So what else could I use? Copper against gold. Now the copper-gold relationship is slightly better in some respects. It's not as strong a trade direction, but it's got a bigger variance in it, right? There's a bigger variance. And because of that, of course, we can start recognizing that that bigger variance gives us a little bit more visibility on a trade narrative. So when I look at copper gold, you can see it's a positive correlation, but you can see it has more distance between the lines. There's a little bit more distance between the lines. Now what I'm looking for is I'm looking for the red to be overpriced against the blue and for the blue to be diverging against the price. The red line should be overpriced against the blue for a sell, and the blue should be diverging for price for a sell. So in other words, when I look at this without the gold price on the charts, I can look at it without the gold price on the charts. I can't see it. There it is there. You can see here that we've got exactly that storyline, haven't we? Take a look. The red line's making a lower low here quite considerably. The blue line I know is making a lower low, but it's not as much. If we take it into the right-hand side, you'll see that there is nowhere near the same comparison between these two. The blue line against that price is rising. The red line is actually at exactly the same level here. That means that is going to be a buy trade in gold. That is going to be a buy trade in gold. So that's a good one. That's a nice, easy to spot one against the gold copper line, because we've got the directionality and we've got the timing on this. Directionality plus timing. And as we catch up with the right-hand edge of the charts, we can see a couple of examples of things going a little bit wrong here for the gold market. You can see, for example, here, there's a nice buyable opportunity there. Do you see that one? The red line's lower, the blue line's higher. So I would be using that to buy some gold into there for sure. And obviously the gold price at that stage, there was a buy trade there. And we got a very nice lift up into the top edges on gold. Directionality, remember, is still important to me. So I want to make sure I'm definitely getting the directionality still correct on this as well. Look at what happened to